Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah, and I'm glad that we have Mr. Dhananjay Sinha with us today. The last note that I read of his, he had forewarned about a few things that might impact the sentiment of global and local equity markets. I would love to talk to him today about whether the headaches of weaker currency, presumably higher crude prices, and more so if China opens up, and a resultant higher current account deficit, could that mean that equities have a bit of a challenge up their hands? Can it force the RBI to talk differently? Can it force valuations to get challenged, if you will? Let's get him in on that conversation. Dhananjay, great having you. Thanks for joining in.
Good morning. Good morning, everybody. Yeah.
So Dhananjay, I remember your previous note, in your strategy note, wherein you had highlighted a few challenges that we have up our sleeve. My question to you is at the start, do you reckon that there is a higher probability of equities at large drifting lower, much lower than where they are before they move higher? Or will this again be a dip that gets bought into, presumably because India is doing slightly better than some of the others?
So I think the way we are looking at is, see, the market outlook will be a function of how growth pans out, what kind of valuation will be there, and third, what kind of risk premium that market actually prices in. So I think if you have a sort of a good view about this, then you know what the answer is. So to sum up, I would say, to start with, I would say that it is more like a scenario where the earnings or growth is going to taper going forward. So if you look at most of the multilateral agencies have actually been scaling down growth forecast for global economy to somewhere around 3 to 2.5%. And India is not immune according to us. We think that the sensitivity of India's growth to global trade has actually risen over the last 10 years. The sensitivity is almost like 175 basis point for every 100 basis point decline in global trade volume, which was a major sort of contributor to India's rebound. So we think that there will be a sort of spillover effect on both in India as well. So, I think back in February, what we were talking about is that after a 40% rebound in earnings growth for Nifty, people were expecting about 17-18% growth in the following 2 years, and we said that it's very optimistic in the context that we are looking at global inflections which are pointing towards a slowdown, and that will permeate into India's growth as well. So we were looking at a scaling down of growth estimates by roughly about 15 to 20% for financial year 23 and 24. We think that India's real GDP growth will be in the vicinity of 5 to 5.5%. This is significantly lower than 7% forecasted by RBI, and the consensus around 6.5, 7%. And I would say that in the following year, FY24, also we are looking at a structural growth of 4 to 4.5%. People are somewhere around 5 to 4.5%. So clearly, either you take the consensus or our estimate, the risk to growth is definitely there. Secondly, on the risk-free rate, which is basically scaling up, if you look at US yields are close to 4%,
right,
10-year, and India yield is about 10 years about 7.5. But more so in the shorter term, there is a significant rise. So I think from a valuation standpoint, if you look at the risk-free premium, that is rising. And the third thing is with respect to market risk premium, that actually is sort of on the higher side. The bias is on the higher side, given the way VIX are moving globally, and the fact that there is global tightening as well in terms of liquidity. US rates are expected to go up to 4.6% to 5%. All those things will have an impact on the overall valuation. So my sense is that it's not a kind of a buy or dip kind of a thing. It is something that will sort of these three factors that I just mentioned will gain grounds as we go forward in the next 1.5 years.
As things stand right now, Dhananjay, in your strategy note, what's the fair value that you assign for the Nifty 6 months out or 1 year out?
So, see, we have been looking at something like a 15,000 to 17,500 as a range for quite some time.
Mm-hmm.
My sense is that you're definitely looking at a sort of a 10 odd percent or 10 or 15% sort of reduction if I just look at the earnings estimate. So in the first quarter, we have already seen a 3.5% reduction in just one quarter. So my sense is that if there is a 15% reduction in earnings, and if I consider the valuations remaining there itself, there is definitely a downside of 10 or 15%. So one can consider that as a near-term sort of a limit. Yeah.
Got it. Dhananjay, okay, thanks for that. The other question is, Dhananjay, have you been able to wrap your head around what could the impact be of the quantitative tightening process? I mean, this drop in liquidity across 4 or 5 large central banks has been very, very large and very steep and
Right.
fairly swift as well.
Right.
Have the markets factored in that impact, or that is still to be felt because it's early days as yet?
So I think it is still early. So there are two parts to the liquidity thing. One is domestic, and the other one is global. I think the most dominant factor is the global liquidity.
Of
So
course.
we have seen that US has increased the rates by 300 basis points. Other central banks have also sort of increased rates, especially ECB is talking about furthermore increase a more restrictive tightening as well in UK as well that is happening. So I think it's kind of a synchronous tightening that's been there. So that's one part of it, and I think more of that will need to happen for the inflation to really come down to what they're targeting. So the FOMC has talked about 4.5%. Many people are talking about 5.5%. So I think more of that is going to happen. What has not happened yet, I would say, is the quantitative tightening. We know that the balance sheet of Fed increased by $5 trillion post the COVID, and the money supply to GDP increased from 69% to 90%. This is the highest ever increase that has happened in the post-war scenario, post-war history. So there is a sort of a long drawn process of moderation of balance sheet. And if at some point of time, even if it sort of stops, the relative ratio of money supply to GDP will still fall. So you are in for a long period of dollar strengthening going forward. So that will have a impact on liquidity globally. So we have seen portfolio flows in India actually contracting by $36 billion from the peak of last year. Recently, there has been a sort of a rebound, largely when markets expected Fed to be more benign. But I think that scenario is also changing after the FOMC last meeting. And I think as a result of that, portfolio flows might remain very modest if I take an optimistic view. But my guess is that it is going to be on the downside. Secondly, on the domestic liquidity, we have seen that there is $110 billion of FX reserve that RBI has actually drawn down to protect the currency. My sense is that our estimated optimal value for FX reserve for India, based on the volatility in imports that we have, which we have projected, it is somewhere around $740 billion, and we are up at $530 billion or so. So there's a more than 200 billion gap between the optimal reserve and what the current levels are. As a result of that, you might actually have a scenario where currency can actually depreciate if you have current account deficit which is hovering around, let's say, 3% or 3.5%, and your capital flows is actually very modest. If you put FII, FDI, if you look at ECB and NRI deposit all put together, that is averaging about 1% of GDP. So there is a 200 basis point gap between the current account deficit and the autonomous capital flows. In the first quarter, there is certain banking sector flows that has happened largely from the PSU banks, but I would say that sort of filled the gap of 2%, but that's a kind of a very sporadic kind of a thing. Structurally, we have a gap which will imply that domestic liquidity will also narrow because of the rundown in your FX reserves.
No,
So
but
I
here's
think
my here's my follow-ups, Dhananjay. Isn't that situation likely to worsen? Because if indeed the rupee is on a downward trajectory, not just because the rupee is doing that, but because the dollar is strengthening, And if crude has perked up, and if China were to open up post their elections, and if that were to perk up crude prices more, then naturally your imported inflation, your CAD, all of that goes for a toss.
So the thing is, as far as the oil is concerned, is largely geopolitics, I would say, the fact that it is hovering around $9,500 or $9,200 is something which is related to the geopolitics, and you have OPEC plus actually cutting the production as well. So the Middle East and the OPEC does want the crude to be around $100 per barrel. The other part is that because of the significant slowdown that is happening in Europe and US and China as well, that things that we were exporting is actually seeing a contraction. So if you look at steel price, if you look at textile, ready-made garments, total exports are actually shrunk by 24% from the peak in March. So you have a sort of widening gap between the exports and imports. So overall trade deficit is hovering around 8% plus of GDP. So you have sort of services export that is happening kind of very stable, but it's not really rising. So my sense is that because of this, the rupee will be under pressure in the context that your actual reserve is lesser. Rupee can actually rise to I would say 85, 86 is what we are looking at in the next 3 to 6 months time.
Wow, that sounds great news. Dhananjay, so how do you play such a scenario? From an equity investor's perspective, I'm hearing Dhananjay Sinha say that the rupee will depreciate. I'm hearing Dhananjay Sinha say that the macros are challenging. And I'm hearing Dhananjay Sinha say that there is a probability of a 10 to 15% downside from where we are right now. So circa 15,500 to 16,000 levels. What does one do with the equity portfolios then? Is it better to sit on large oodles of cash, or do you believe that there could be themes that could do well even in such a scenario? And since one can't time the market, try and make presence in those themes. What would you do?
So we have been tracking this. I mean, we were predicting kind of a scenario that is happening now from a global standpoint. The liquidity tightening and the slowdown, etc. We have been talking about it since last 1 year. And what we have done is really look at past history and try to see how equity markets behave, which sectors does well, which doesn't do well. We have tried to look at all of that and try to put that into our portfolio view. And this is not a perfect view. Things are evolving, and we have to really be nimble about it. So, what we have been focusing on is our domestic themes. We have been overweight on consumption, for instance, for the last 1 year. Again, here we are sort of tapering our view as well. We were overweight on autos, has done phenomenally well. We were underweight on metals, and that pair has actually been doing very well. I would say with the valuations that have increased as far as an outperformance that has happened in autos, you might actually see some amount of correction. We are seeing that. So we have reduced a little bit of overweight on autos. It's still about 100 basis point higher than the Nifty weightage. Secondly, what we had been doing is we had increased our exposure in FMCG, for instance. We had ITC, we have HUL, those kind of names, GCPL, etc. So I think there also it has done well. What we can really do is we can look at the urban consumption theme, because between the rural and urban now, what we are seeing is that the traction as far as the urban is somewhat better. So look at QSRs or organized retail stocks, etc. There is good traction there. So we are looking at that. In the engineering and cab goods, I would recommend liquidating exposure in export-oriented companies where the valuations are at almost like a 14-year high. There's good traction even now on the order books, and these are very export-oriented order books, especially in the US and all. So I think I would reduce that. As far as
so I'm not saying names, but the likes of Cummins, ABB. I mean, that's the variety you're talking about. MNCs.
Yeah. Tomax, Cummins, ABB, LMW, those kind of stuff. LG equipment, those kind of stuff.
Okay.
So these are so as far as so we are sort of more comfortable with defense names such as HAL and BEL, those kind of stuff. And I mean, BEL has been there in our portfolio for the last 12 months. It has done well. Some of the consumable names have done well. So I think that has done. I mean, I would not get too much bullish about that. I think best is in the price. Chemicals can actually see a sort of a risk largely because of the export exposure that that people have, those companies have. And then pharma is something I have gone significantly overweight. Pharma, utility. So I think uh, we are seeing a good value, and there is underperformance for the last 1.5 years. So pharma is something I've gone significantly overweight. People are generally overweight on banks because there is a good traction as far as lending growth is concerned. Lending growth has gone up to uh, almost like 15%. Within that, retail lending is growing much more. My sense is that as growth slows in the second half of the year and next year, you might actually see credit risk issues coming back again because of the slowdown and the fact that retail lending is growing much faster than income growth, and there is a risk. There could be a risk to that, and I would say that a lot of as far as the credit growth is concerned, it is also a switch over from market borrowing to the banking borrowing, and what we find is that especially for MSME and all, there is a stress that is happening from export-led flows. There is a contraction out there, as we know from the exports are contracting. So there is a sort of a tightening of operating matrix that is happening as far as the MSME is concerned. So increase in lending that is happening also reflects the kind of tightening in operating matrix that might be happening, and that could actually imply that banks are absorbing incrementally more risks. So I would say I'm sort of underweight on banks at this juncture. And on the valuation front, for the banking sector, a strong dollar, weak rupee is not very helpful.
Yeah. My final question, Dhananjay, a sector which seems to be in an upcycle. Every month we hear property registrations looking rock solid, but rising rates might play spoil sport. So there are pulls and pressures here. Which side of the argument are you on?
So I would say that real estate selectively has been doing well, and there is a pent-up demand as well because your real rates have been negative, and banks have been pushing a lot. Banks and NBFCs have been pushing a lot on the retail lending side, especially mortgage. So I think all these things are good, especially in select pockets where you have IT hubs and all. There was good traction as well. But my sense is that it might actually be at the peak level because you have sort of rising prices as well, and the rates are also rising. So I think you might see some kind of a moderation going forward because of the fact that these affordability issues are there. But I think the valuation is very sensitive to the rate cycle, interest rate cycle. So in a scenario where rates are rising, your cost of construction is on the higher side. I think the valuations are actually sensitive to these variables. So I would say, I would trim my position as far as the realty is concerned. At this juncture, I don't have any realty stock in my portfolio.
Dhananjay, always good talking to you, combining the macros and the micros. Thanks for doing that yet again, and much appreciate you taking the time out.
Thank you very much, Niraj. Have a nice day.
Thanks for tuning in to this leg of the Talking Point.